أوه. Hi, Brenda. How you doing? There she is.
Good
How are
morning.
you?
How are you?
You ready for the
I'm
next
doing
chat?
good, thank you.
All right. Where are you? In the car someplace?
Yeah, I am.
You look cold. Okay. All right. You ready to hang in there then, huh? Okay. Our chapter.
Yes.
Okay. All right. Let me just rack this up. Oh, share screen. Share screen. Hopefully, you find this chapter interesting. It's about how companies raise money by issuing stock. If you remember in the earlier chapter, we talked about,
Um, I
yeah,
thought we were doing chapter 5, no?
chapter 5. Hold on. Oh, maybe I have my classes mixed up. I'm so sorry. Okay,
Okay.
you're right. I'm sorry. I'm mixing you up in my other class. My
No, it's okay.
my 2:30 class. Yes. Oh my goodness. I would have gone way ahead in a different class. Okay, so give me a moment here.
Mhm.
All right. Okay. Who's there? There we go. So we're accounting 110 67954. And chapter 5 it will be, huh? Let's see here. Chapter 5. Ooh, chapter 5. Adjusting journal entries. Okay, I have to hit that button. I have to do this. Okay, just about there. Okay, you see the chapter 5 screen now? Let me ask you a question, Brenda. Are you pretty good now with the debits and credits?
I think so.
Okay.
I memorized that chart that you with the balances.
Oh, okay.
Yes,
That little drawing I did with the T account.
yes,
Oh yeah, after eating dinner, let's read comics. That one.
yes.
Okay. Very important to master those debits and credits by now, because we're going to do a little more analytic type work in chapter 5. Okay.
Okay.
Chapter 5. What an important chapter. We learned that at the end of the month, we prepare a trial balance to
Mm-hmm.
use in preparing the financial statements. Okay.
Mm-hmm.
We entered all our transactions during the month. We know our debits and credits. The month ends, we run a trial balance, and then we did financial statements. What we're going to learn now in chapter 5 is that trial balance was incorrect. It was incomplete because all ending trial balances must be adjusted. And we're going to talk about what are called adjusting journal entries. We're going to talk about journal entries that are internal, they don't affect outside businesses. We're going to talk about depreciation and what do we do with those prepaid accounts and wage accruals. So let's see what we're talking about here. We'll divide and conquer. We know revenues are recorded when they're earned, not when the cash is paid, not necessarily. Same thing with expenses. Expenses are recognized when they take place. We don't care whether we've paid for them or not. That's the matching principle on the test. They love to ask this question. The matching principle, what are we matching? We're matching revenues and expenses. Revenues and expenses. If we do that, we get a proper net income to report. A fiscal year, we know, I think, a fiscal year can be any year. It doesn't have to be from January 1st to the end of the year. It can be March 1st to February 28th, if you will. Fiscal year. I own stock in a company called General Mills. They make cereal. Their fiscal year begins, I believe, in May, planting season. A lot of these fiscal years, going back years, match the actual movement of the product. Okay, adjustment number 1. We have prepaid supplies, right, Brenda? And we
Mm-hmm.
counted them. And we had 80, rather, we bought 80. So we debited prepaid supplies. We probably credited cash. Now the month has come to an end, and you sent me, I work for you, you sent me out to the supply room. You said, Bob, go out and count the supplies. How much do we have left? I come back and I say, Brenda, there's only $20 left. So my question to you, Brenda, is how many did we use?
60.
Yeah, not that tough to understand, I don't think. Yeah, we used 60. The 60 we used is the expense for the month. So we are going to debit supplies expense to increase the expense, and we're going to credit prepaid supplies for 60. Take a peek here. If we can understand this, we're 1/4 of the way done with the adjustments, okay? We had an asset. We ran the month-end trial balance. There was $80 there. You counted, or I counted 20. That brings the supplies expense to 60. Hi, Liz. How you doing?
Hi, I'm doing well, thank you. Sorry,
Good
I'm
to see
running
you.
late.
Good to see you. We're kind of just getting started here. Adjusting entries. I was just telling Brenda, the end of the month, your trial balance has to be adjusted. It's no good. The trial balance that we've been showing you has to be adjusted. And we're talking about a few things here, and we're just starting here. Supplies, we had $80. We went out and counted 20 at the end of the month. So our expense is 60, and we've used $60 of that asset. So the balance of that asset has gone down to 20. That's our adjusted balance. Take a look at the journal entry. We debit supplies expense. We credit supplies, okay? Prepaid supplies. Prepaid insurance is the same thing. So Liz, you got in here a little late. Here's the same exact situation. Prepaid insurance. You can have prepaid supplies, prepaid insurance, prepaid taxes, prepaid rent. You can have all kinds of prepaids. Prepaid insurance. Mitchell bought an insurance policy for $700. This number's wrong here. That should be 700. He bought an insurance policy for 700. At the time of the purchase, an insurance policy is an asset. It's an asset. We haven't gotten any use out of it yet. So he paid 700 for 10 months. That's $70 per month. So he bought the policy, we'll say, in December of 2023. He spent $70, and now he has that asset called prepaid insurance. Every month for the next 7 months, he has to reduce that asset to reflect the expense. At the end of the first month, we're going to debit insurance expense, credit prepaid insurance, and voila, here we go. Insurance expense, we now debit. He had 700, and now that asset has gone down to 630. We debit insurance expense with the journal entry, credit prepaid. Okay, that's roughly 1/4 of our types of adjusting entries. The prepaids, you're always going to be crediting a prepaid account and debiting expense. By the way, hear me out, ladies. Your adjusting journal entries will always debit an expense. Your adjusting journal entries, no matter what they are, will debit an expense, and it will credit something from the balance sheet. So you're always debiting expense, you're crediting something from the balance sheet, and you never have cash. You never put cash down in an adjusting journal entry. And the reason I'm chuckling is I've been teaching this stuff forever. And every test, there's a couple of students who get stuck and they go, oh, it must be cash. Okay. So we just went through what are called the prepaids. Rohan paid his employees $16.50. What we're talking about here is a wage accrual. This is called an accrual of an expense. An accrual, ACCURAL. We're teaching accrual-based accounting, right? An accrual of an expense recognizes that we incurred an expense, even though we haven't paid for it, and we may not even know what the exact number is, but we still have to record something. So again, we're going to debit an expense, and this time we're going to credit a liability. So let's see what we're talking about. You are both working ladies, I would assume. You've been out in the workforce. When you go to work when you leave work on Friday evening Friday afternoon, the week is ended. You don't get paid for those hours yet because the boss holds back. You get paid next week or maybe 2 weeks from now. The point, though, is you did work those hours in the current month, and those hours must be recorded as an expense in that month. So Rohan has paid its employees $16.50. They've now paid an additional $400. Not paid, I should have said that. No, they've earned an additional $400, but haven't paid yet. So let's see what we're talking about. You worked on Monday, Tuesday, Wednesday. You worked on the 27th, the 28th, and the 29th of February this year, leap year. You earned $400 during those 3 days, that Monday, Tuesday, Wednesday. You're not going to get paid for 2 more weeks. But the month comes to an end, and we have to say that Brenda and Liz, they earned $400 on those days, the 28th, 29th, and 30th. We have to record that as an expense, even though you're not going to get paid for 2 weeks. So we're going to accrue it. Accrue it means build the expense up. We're going to debit wages expense and credit wages payable. Let's see it visually. Okay, let's look at our general ledger here. Wages expense, $16.50. That was the number they talked about here, $16.50. This is the payroll, in my example, from February 1st till the 26th of February. This $16.50 has already been recorded. It's already been paid. So the payroll from the 1st of the month through the 26th is okay. We've got that. It's that $400 that you guys earned that Monday, Tuesday, Wednesday, ending the end last day of the month. We have to debit the expense, credit wages payable. It should say accrued wages payable. That's okay. Wages payable. We debit an expense always, and we credit wages payable. It's a legitimate expense because you worked those 400 hours in February. That's where that cost belongs. If we don't make this adjusting entry, we are going to understate our expenses by $400, and we are going to overstate incorrectly our net income because we haven't properly matched the revenues and expenses. So we debit wage expense 400, we credit wages payable 400. That's a liability, a current liability. It's a legitimate liability in every way. If you quit at the end of the month on the 29th, the boss has to pay you. They got to hand you a check right there because they do owe it to you legally. Legally, they owe it to you. You just are a nice employee. You agreed to their policy of waiting a week to get paid. If the company went out of business that day, you get your money. It's a legitimate debt. Let's have some fun with fixed assets. Fixed assets. Fixed assets, plant assets, your book sometimes calls them. These are the very expensive assets that are going to be around for a long time, hopefully helping us to generate income streams, okay? So we bought a big asset. When we paid $100,000 for that truck out in the parking lot there, that $100,000 cost is going to stay the same forever on the balance sheet. It's called the historical cost principle. Everything on your balance sheet is carried at what you actually paid for it. Okay? We are never going to reduce that account. We debit equipment, we credit accounts payable. That equipment, say $100,000, that number's never going to change. Never going to change. Okay? Unless we sell it. Never going to change otherwise. So we also need to understand this. No adjustments are made for changes in the market value of the asset. We bought a fixed asset for $100,000, and somehow it's become a collector's item of some kind, and people are offering us $1 million for it. We cannot raise the price of that asset to its market value. Cannot do it. You can never anticipate a gain. You only must anticipate losses. So I'm getting a little off track here, but that's the warm-up for what we're going to call, in this case, depreciation expense. When we buy an asset, we must come up with what's called the useful life of the asset. The useful life, meaning how many years is this asset going to work until it's a piece of junk? We recognize the wear and tear. So we must estimate the useful life. We hired Liz here as our sales manager on the West Coast. We went out, we bought her a fancy $100,000 super SUV with all the bells and whistles. And boy, Liz is going to be driving that car up and down to Vancouver, down to San Diego, putting tons of miles on it. We might say the useful life of that car is only 3 years. Okay? If it's a car for an executive who gets a car just because he or she's a big shot, well, maybe we'd say it's 10 years. The point is we must estimate a useful life. And that's an important term. What is depreciation expense? The word depreciate means losing value. It depreciates. Sort of like some of my investments in the stock market, right? Depreciate. In the world of accounting, depreciation expense is a method matching the asset's original cost against the future revenues. Lots of depreciation methods. In this course here, we're just going to work right now with what's called the straight line method. The straight line method is the most popular one used by businesses throughout the world. Straight line. So we're going to look at the useful life and the salvage value. Useful life. Let's understand another term that comes into play in this expenses calculation. It's called the salvage value. And it's the expected market value or selling price of an asset at the end of its useful life. Remember that car we bought for Liz where she put a couple 100,000 miles on that car in just 3 years? Well, we think at the end of 3 years, that car is going to be worth maybe $1,000 to a junk dealer. Salvage value, residual value, what an asset is worth at the end of its useful life. We must estimate it in advance. Now, hopefully I'll tie all these terms together you're seeing for the first time. Depreciation expense, useful life, salvage value, straight line depreciation. Pretty simple method. Mitch bought motor scooters. Remember those motor scooters he bought we were always working with? They cost him $4,800. And he thinks that these scooters are going to last 5 years. 5 years, no salvage value. $4,800 for 5 years. We're going to spread that cost over the next 5 years or 60 months, right? 60 months. He bought the asset for $4,800. 5 years or 60 months comes to $80 a month. $80 a month. That is going to be our debit to depreciation expense. Okay. Depreciation expense journal entries should be fairly simple when you did a little bit of homework, because it's always the same. It's always a debit to depreciation expense and a credit to a new account you're seeing for the first time called accumulated depreciation. Notice the delivery equipment is not reduced, because we just said everything on your balance sheet is carried at its original cost. So that $4,800 is going to last there forever. We're going to credit an account called accumulated depreciation. Accumulated depreciation. Say hello to your first contra account. Fortunately, I'm bilingual and I can translate that. It's contra from the Spanish word meaning contra. Okay, it means the opposite. A contra asset has a credit balance. My goodness, a credit balance. Assets have a normal debit balance. Assets are increased with a debit. Accumulated depreciation is an outlier rather, called a contra asset. And what we're going to do is we're not going to credit the original cost of the asset. We're going to credit this accumulated depreciation account, which is carrying a credit balance. We do not reduce the original cost of the asset. What we do reduce is the resulting net book value. The value carried, net book value. It's the original cost of the asset minus the accumulated depreciation. Or you can call it the undepreciated part. Original cost of the asset minus accumulated depreciation gives you net book value. Let's look at it. Let's take a deep breath here. Not too tough once you do a few of these. We know the expense is $80. We know the journal entry is always, without an exception, a debit to depreciation expense and a credit to the asset, accumulated depreciation. We did not reduce the original cost. We reduced got happy fingers. We reduced the net book value. The net book value, the original cost minus the accumulated depreciation. So on your balance sheet, you're going to see one line, and that one line is going to say delivery equipment, $4,800. The next line on your balance sheet is going to say less accumulated depreciation, $80. Your net book value is the difference, $4,800 minus $80. equals 4720. The next month, when you layer in another 80, that balance is going to go down to 4760 or 4740, whatever. You're reducing the net book value. The net book value is the amount that still needs to be depreciated. And they're just showing you a couple of new accounts here. For the first time, you're seeing accumulated depreciation. And please note that delivery equipment has an account number of 185. The contra accounts typically have 185.1. And that's how I've seen it when I used to actually work for a living, right? They always ask that question on the test. They'll hand you an account and they'll say it's 185.1. Tell me what kind of an account it is. And you have to know it's a contra. We introduce you to wages payable. And you're seeing supplies expense, interest expense, and depreciation expense for the first time. In our first 4 chapters, supplies were an asset, insurance was an asset, because we hadn't consumed it yet. Posting the adjusting entries. Wow, can you believe we've gone through all of the adjusting entries? Let's keep punching away at it now. Now we're posting to the general ledger. The first entry was $60. If you remember, we purchased 80 and I counted 20. That meant we used 60. So we will debit supplies expense for $60. Let's look at it here now. Here is your journal entry. We debited supplies expense for $60, reduced the asset called prepaid supplies by 60. Whammo, we hit the post button, and here's what we have. Your general ledger now has a balance of $20 in the asset account, supplies, and your expense has gone from 0 to 60. Same concept with the insurance. The insurance was a 7-month policy at $700 or whatever it was. It came out to $70 a month. $70 a month. We debit the expense. We reduce the asset, the prepaid. And here's the posting to the general ledger. We purchased the policy for $700. We've consumed 70. So the policy balance has gone down to $630. And our insurance expense went from 0 to 70. Okay. Hold on one second. And here are our other 2 entries. Take a peek. Wages. Oh, you guys worked 3 days at the end of the month, but you're not getting paid till next month. We owe you that money right now. We owe it to you right now. We have to recognize that liability with a credit and record the commensurate expense. Okay. Our wage accrual is always going to be a debit to the expense, which brings, in this case, the total expense for the month to $2,050. Remember, they had already processed the payroll through the 26th of February. You worked on the 27th, 28th, and 29th. You're not going to get paid for a while, but you worked it in February. So that's a February expense. That's a debit to wages expense. and a credit to the liability. You're increasing that liability. Now, depreciation expense. Depreciation expense. We figured out that those motor scooters cost us $4,800 at 60 months of life, $80 a month. So for the next 60 months, you're going to write the same journal entry. You're going to debit depreciation expense and credit accumulated depreciation. Okay. Do you have any questions so far, Brenda or Liz?
No questions.
You okay so far? Okay.
No questions.
Okay. This is you can tell I'm taking a lot of time to go over this in pretty good detail because this is a tricky little concept and students can find this a little bit difficult, even though it's just really 4 items, right? 4 supplies, insurance, wages, and depreciation expense. Okay. We have now done our adjusting journal entries. What this means is we need to prepare an adjusted trial balance, a correct trial balance, a complete trial balance. So they talk about this worksheet, pulls together all the information. The worksheet, it's not a financial statement, typically an Excel form, and it's used by the accounting department, 10 columns. Let's get an introduction to it. Preparing the worksheet. Well, remember we prepared a trial balance. Then we had adjustments. We're going to take that trial balance, add or subtract, or better said, debit or credit the adjustments to come up with an adjusted trial balance, which is now blessed. And from that adjusted trial balance, we can prepare the income statement and the balance sheet. 5 steps, 10 columns. Each of these 5 steps has a debit and credit column. So I don't care what you put on the header for the trial balance, for the worksheet. It's just a worksheet, okay? And they're giving you some rules when to underline. We're not going to worry about that. Okay. Once we do figure out how many lines we want to draw, we're going to record the adjustments. We're going to record the adjustments. And after we record the adjustments, we are going to prepare an adjusted trial balance. So look at your 10-column worksheet here, ladies. 10-column worksheet. I have no idea why they do this on the test, but they love to ask at least 2 questions where they'll say, what's in column 5 and 6? And you have to be able to say, column 5 and 6, that's the adjusting trial balance. You don't have to memorize it once you understand the sheet. Your first 2 columns, column 1 and 2, the trial balance. Columns 3 and 4, the adjusting entries. Column 5 and 6, the adjusted trial balance. 7 and 8, income statement. 9 and 10, balance sheet. I'm just trying to give you some low-hanging fruit before the test, okay? So know those columns right off the top of your head. And since you're going to be doing this worksheet quite a bit on your homework, you're not going to memorize it, you're going to know. You start with the trial balance. These are the balances we had in chapter 4 when we did some statements. We did journal, we did the balance sheet and the equity statement and the income statement. Here we go. Step 1. Oh, for heaven's sake, hold on here with me. Step 1, you simply put the trial balance down here. The month ended, you throw the trial balance down. You've been doing that for 4 chapters now. You're experts. Now, though, we had adjusting journal entries. So we have to carefully post those journal entries to our worksheet. We will start with the debits. We debited supplies expense for the 80 minus 60. We debited supplies expense. We had 80. We counted 20. We debited insurance expense. That's the $70 a month in insurance expense. We debited wages expense for 400, the 3 days you worked at the end of the month. And we learned a little bit about depreciation expense. We debit depreciation expense. Please remember that all adjusting journal entries in this course are a debit to an expense. Adjusting entries are all about finding and recording unrecorded expenses. We're looking for missing expenses. What are the credits? Well, if you debit supplies expense and you debit insurance expense, I bet you're going to credit prepaid supplies and prepaid insurance. Not so tough. We had the accrual of the payroll. We debited wages expense. We credit wages payable, accrued wages payable. And lastly, we had debited depreciation expense, and you automatically credit accumulated depreciation. On the test, you're going to have a multiple choice question or two where they're going to lay out 4 possible journal entries to record some depreciation expense. All you need to remember is it's always the same. You debit depreciation expense, you credit the contra asset called accumulated depreciation. Okay. Let me make one more point about the contras that might help you a little bit. All contra accounts, and you'll run into a few more during this course. And then when you guys get into 230 and 240, there's a few more. It's not a lot of them. But what they have in common is a contra account is always married to somebody, or at least in a very significant relationship, okay? Accumulated depreciation is married to the asset account, meaning when you put them together, you're going to get what's called the net book value. The contra accounts are meant to reduce the asset value of an account we never touch. Remember, we never credit delivery equipment. We've now done the hard part. We did the hard part in putting this worksheet together. Man, we printed out that beginning trial balance, and we went through it, we analyzed it, and we came up with these adjusting journal entries. The hard part. Let's keep going. I said, let's keep going. Step 3, prepare the adjusted trial balance. What we're doing here is we're looking at columns 1 and 2, which is the beginning unadjusted trial balance, and increasing or decreasing with a debit or credit as needed to come up with an adjusted trial balance. Remember I said we did the hard part already? Let me show you why. It's not that tough. Look at this. Take a peek. We started off with a trial balance, and it balanced. Hooray, hooray for us. We then prepared those 4 journal entries. Now we have to take this beginning trial balance and meld in the adjusting journal entries. So we need to go through every single account here, even though we know only these four are going to change and these four. Cash and accounts receivable. You don't adjust cash. You never adjust cash. It's not like supplies. We don't send somebody out into the safe at the end of the month and count the cash, and they come back and they say there's $14,000 there. And we look at our records and we say, gee, there's 14, huh? We're supposed to have 15. Okay, write that off. That's an expense. No, you don't adjust certain things. What do? We just bring the balance over. 4,700, 3,100. On our adjusted trial balance, there they are. Supplies, they were 80. We put an expense in of 60. We reduced that asset. The new balance is 20. We started off with $700 in prepaid insurance. After we consumed 1 month of that policy, the asset balance has gone down, I say, to $630. The motor scooters were $4,800. We never credit the original cost of the asset. What do we credit? We credit the accumulated depreciation. Notice there's no balance for accumulated depreciation. That's because this was a new company. This is the first month of its existence. So we had none to begin with. Now we have a credit of 80, right? The new balance is 80. Accounts payable, you don't adjust that. You bring the number over. Wages payable were 0. Now we acknowledge that we owe $400 to you two for working at the end of the month. Capital and drawing and sales, which they're calling delivery fees. We're never going to adjust capital or drawing or sales. Look at our expenses. Wages expense was $1,650. The payroll through the 26th of February. We layer in those next 3 days. Now our total expense is $2,050. Rent expense was $1,000, no adjustment, $1,000. Supplies expense, we had none until we counted what was there and came up with an expense of $60. Phone expense was $100, no adjustment. And we have insurance expense, depreciation expense, there was 0. They're now 70 and 80. When we put the schedule together, we made sure that the trial balance, the original trial balance, balanced debits equal credits. And we made sure that the adjustments balanced. And now we're making sure that the adjusted trial balance is in order, debits equal credits. Now, we will prepare our financial statements. So let's see what that's all about here, huh? Our next step in columns 7 and 8 is to prepare the income statement. The income statement. My goodness, we now know, don't we, that the income statement is simply sales minus expenses, revenues minus expenses. Nothing in there to throw you off, okay? Let's take a look here, Brenda. How do we know what's on the income statement and what's on the balance sheet? You know, because I've told this class and other classes a million times that your trial balance is always presented in the order of the chart of accounts. Assets, I see a couple of liabilities, a couple of equity accounts, assets, liabilities, equity. Right after the last balance sheet account starts your income statement. Find the first revenue or sales account, which is in this case delivery fees, and you know that delivery fees and everything that follows is your income statement. Cornelia and I are never going to give you a trial balance that is out of order. Some other teachers like to do that. I think it's kind of dirty pool, okay? Because it can really mess you up. The income statement is right here. So let's go to our new trial balance. And what were the sales? $8,000. What were the expenses? I see 2050 and I see 60 and 100. Okay. We add down and now we don't balance. We don't want to balance those two columns. We don't want them to balance just yet. We want to see a sales column that exceeds the debit column. Sales, expenses. So 8,000 minus this total of 3,360 gives us a net profit, a whopping 4,640. This guy really put together a great business, didn't he? 4,640 is our net income. We're just going to bring this 80,000 down and then add the 3,360 expenses plus the income, just to show a nice tie out. $80,000. Now we do the balance sheet. Everything above the delivery fees is the balance sheet. 470, 3,100, 2,630, 4,800. Don't forget that accumulated depreciation carries a credit balance. We got a couple of payables. We have capital and we have drawing. We add those two columns down, and guess what? They don't balance either, nor do we want them to balance. If we've done things correctly, we're going to be out of balance on the balance sheet columns by the same amount we were on the income statement. And to rectify that, we're going to end up crediting equity when the time comes via the net income. We add down, we're in balance, okay? The worksheet, I don't think is terribly onerous. This is the hard part here, knowing what the adjustments should be. After that, it's just swaying across. And they talk about finding errors on the worksheet. And, yeah, I'm not going to get into that too much right now. We'll talk a little bit about that later. Remember, what we just did was we put the numbers on the worksheet. Don't forget, we have to post them, right? We have to record the journal entries. So here we go. They're just reminding us, writing the numbers, entering the numbers into this Excel spreadsheet, don't feed the bulldog. We must, of course, prepare the 4 necessary journal entries. And I'm not going to drive you crazy by going over them again. Explain the cash, modified cash, and accrual basis of accounting. No, I am not going to do that. We teach only the accrual basis of accounting. It is the only GAAP-approved accounting system. Generally accepted accounting principles, remember that? Demands accrual-based accounting, which means revenues are recorded when you make the sale or you perform the service. Expenses are recognized when they take place, meaning when they're incurred. The matching principle, it's all about the matching principle, matching revenues and expenses. Revenues and expenses. What do we match? Revenues and expenses. I'm not going to talk about the cash basis. Not doing this, not doing this. And we are done, Brenda. What do you think? Think you can handle this chapter?
I think so.
Yeah, I probably made it sound harder
I
than
have to admit that the homework exercises, the Cengage homework exercises that we have to do, they are very time consuming because they are not, you have to scroll up to be able to see and it's back and forth and it's just very time consuming.
yeah, they do. We do give a lot of homework in this chapter, but I'm afraid that's the nature of the beast.
Yes,
You
yes.
learn it by doing. What is your
And
major?
practice.
Yeah, what's your major, if I might ask, Brenda?
Well, I started taking this class because my husband got his own business, and I would like to start learning some of the financial bookkeeping sort of things.
Excellent.
But I have a major in nursing.
Nursing. Oh, good for
Mm-hmm.
you. That's great. That's
Yeah,
great.
I have a master's in nursing.
Excellent.
But yeah, trying to learn something new.
Yeah, this class should help you to aid your husband in his business. Does
Yes,
he maybe he uses QuickBooks? I don't know.
we
Um,
do. We do have QuickBooks Online. I'm also taking the QuickBooks class, the non-credit class that SBCC offers.
Excellent.
However, I think what we have is limited to, there are different types of QuickBooks accounts. So
Right.
um, it limits certain access to certain things. So I still have to find the logistics of it.
Yeah.
The class is based on QuickBooks software, so it's more of desktop
Yeah.
QuickBooks. Yeah, trying to figure that out. But yeah, practice.
Yeah. Good
Make
for
it.
you. Well, this class will tie in nicely with the QuickBooks as you go along. Who's teaching
Yeah.
that class? Carolyn?
Uh-huh.
She's a nasty old goat, ain't she?
Yes, she's great. She knows her things.
No, Carolyn's great. I always teach Carolyn. All
Yeah.
right. Well, I'll let you go then, Brenda. Nice to see you, and
Thank you.
hopefully,
Nice to see you too.
hey, see
Thank
you
you.
next week. Bye bye. Hey, listen, see you. You go. I'm done, buddy.